You are welcome to Tuition with Willow, where learning is fun, easy, and exciting. Today I come to learn business income. So, what is business income? So, a person's income from a business for a year of assessment is a person's gains and profits from conducting a business for the year or for whatever period in that year. So, in calculating a person's gain and profits from conducting a business for a year of assessment, it includes the amount referred in a subsection 3 if they are derived from by the person during the year of the business and exclude the amount referred to the subsection. Now, in doing business income, as I said earlier, it's talking about the gains that a person has made in conducting a business, the gains and the profit that the person has made. Now, in doing the calculation to get a gain and a profit, there are some income that we include and there are some that we don't include. So here we're talking about the amount to be included as a business income. The first one is service fee. Now, service fee talks about you rendering services. So if you're rendering services in a business, the service that you render to people, the money that they give to you, what is service fee? You have consideration received in respect of trading stock. That if you deal in goods and services, if you sell, the income that you receive by selling the goods, you call it. And you have gains from realization of capital assets and liabilities of the business as calculated under Part IV. So any gain or realization that you will get, okay, from disposing, okay, or selling an asset. So gains simply means that when the money that you have received is higher than the expenses, okay, the cost you incurred in buying it. So if the cost of the asset is 10,000, and then you sell it at 15,000, so the 5,000 becomes the gain. This is what you're talking about. So the 5,000 becomes the gain. Now, we have amount required to be included by the third schedule on the realization of a person's depreciation asset of a business. That's if, according to the depreciation schedule, the third schedule, it says that if you dispose an asset of a business, if you get gain, I mean, the written down value of the asset is lesser than the money that you received. That means that the money that you receive from disposing the asset is higher than the written down value. The difference is called gain, and that gain is added as income. You have amount derived as a consideration for accepting a restriction on the capacity to conduct a business. So, example is, let's say in your normal capacity, you can produce 10,000, just in your normal capacity, 10,000 units. And you enter into agreement with someone, maybe a competitor, who says that we are begging you, instead of the 10,000, produce 8,000. Then we pay you this amount for producing less than your capacity. So that 2,000 that you are not going to produce, and the money that they are going to give to you as a result of the agreement, you have to add that money to your income. We have gifts received by the person in respect of the business. So if you are doing the business, the gift that you are going to receive, you can add it as a business income. Now, amount derived that are effectively connected with the business, and that would otherwise be included in calculating a person's income from investment. So any amount that you're going to receive as a result of the business, you add it. And other amount required to be included under the section 54, 58, part II and part VI. Now, as we have the amount that we include, in the same way we have an amount that you have to exclude. The first one is exempt amount and final withholding payments. So any money that is exempt, any money that you exempt, okay, you don't add it. And any final withholding payment, you don't add it. And amounts that are included in calculating a person's income from employment or income from investment. So if you are getting income from employment, you don't have to add it because this is a business income. Now, as we've spoken about the income to be included, in the same way we have expenses to be included and expenses not to be included. Now, the following rules apply to deductions in calculating a person's income. No deductions are allowed. In calculating the income from employment, this is a general rule. A domestic or excluded expense incurred by the person. And B, a specific deduction rule shall take precedence where more than one deduction rule applies. So remember, this is the general rule. Okay, this is the general rule. However, if a specific deduction rule, if there is any specific deduction rule, that one shall take precedence over this general rule. So let's talk about some of the specific rules. We have residual deduction rule. Now, in calculating the person's income from conducting a business, or investment for a year of assessment, deduct expenses to the extent that they are wholly, exclusively, and necessarily incurred during the year by the person and in the production of income from business or investment. So they are saying that for you to deduct an expenses from business, okay, the expense must be wholly. That means that you must spend it wholly on the business, exclusively, and it must be necessary. It must be important. It must be of importance. So, example of some of the expenses that is not classified as necessary is end of year party, because end of year party it wouldn't affect production incurred during the year by the person and in the production of income from the business or investment. Now, no deduction is allowed under subsection 1 for an expenses of a capital nature. Yes, any expense of a capital nature is not added. In this session, expense of capital nature includes an expenses that source a benefit lasting longer than 12 months, like assets. Okay, your assets. Now, we spoke about wholly, exclusively, and necessary. What is the meaning of wholly? Wholly refers to the quantum of expenditure, that is the amount incurred in respect of a particular transaction. So for the expense to be allowed, the whole amount should be related to the production of the income. So for an expenses to be classified as part of business expenses, you must spend that money on the business. So if you spend 10,000 cedis, and after that 10,000 is only 8,000, that is referred to the business. We treat only the 8,000, not the whole 10,000. Now, exclusively refers to or relate to the purpose for which the expenditure was incurred. In other words, the expense must be relevant factor to the operation of the business. That is very important. And necessary implies that the expense must be inevitable. That in other words, without incurring the expenses, the business cannot go on. So as I said earlier, end of year party is one example. But it's not important. I mean, end of year party wouldn't affect the production of the business. Yes, you can justify yourself by saying that it gives staff and motivation, those kind of things. But from the task concept, we don't see it to be important. All right, let's come to other rules. We have interest. Interest. Now, for the purpose of section 9, interest incurred by a person during a year of assessment under a debt obligation of the person is incurred in the production of income to the extent that where the debt obligation was incurred in borrowing money, the money is used during the year or was used to acquire an asset that is used during the year in the production of income. And B, in any other case, the debt obligation was incurred in the production of income. So here, what you are saying that if you go and borrow money, and the money that you're going to borrow is going to be used for the production, or is going to be used in that year, then you classify that one as an interest and you can deduct it. But if that loan is not used for anything that generates income for that year, we don't add it. So they are saying that example is if you go and borrow money like 5,000 Ghana cedis, and this 5,000 you used to go and buy raw materials, the interest on this 5,000 is allowed. Or you go and borrow money 5,000 Ghana cedis, and you use that 5,000 to go and buy an asset that is going to be used for production, it's allowed. But if you go and borrow money, and let's say the money that you're going to borrow, you use that money to go and do special works at the director's house, that money is not allowed because you are doing works at the director's house. And how is this affecting production? So the interest on that money wouldn't be allowed. So under this concept, under section 9, which is interest, we say that if the interest is incurred for the purpose of conducting the business, solely for the business, we deduct it. Now, rent. For the purpose of ascertaining the income of a person for a basis period from any business or investment, there shall be deducted any rent incurred during the period in respect of land or building occupied by that person to the extent that the land or building is occupied by that person for the purpose of producing an income. So the income, the rent that you are going to pay, it must be used by or used in the production. Maybe you're going to use as a warehouse, you're going to use as office, but you must use that one to produce an income. We have repairs and improvement. Now, expenses for the repair or improvement of depreciable assets and meeting the requirement of section 9 may be deducted irrespective of whether they are of capital nature or not. However, deductions referred to in subsection 1 granted for a year of assessment with respect to depreciable assets in a particular pool of depreciable assets of a person shall not exceed 5% of the written down value of the pool at the end of the year, and B, are allowed in other infrequent expenses are incurred. 3. Excess expenses for which a deduction is not allowed as a result of the limitation in subsection 2. Subsection 2 is added to the depreciation base of the pool in which it relates. So this is what they are saying. When it comes to repairs and improvement, others will say repairs and maintenance. Yes, when you make maintenance to your vehicle, when you make maintenance to your computers, your buildings, yes, it's allowed as an expenses, but it's just a rule. The rule says that it shall not exceed 5% of the written down value. So let's give an example. You have a pool 2, you have a written down value which is 8,000, and you make repairs and improvement, so repairs and maintenance, and it costed you 2,000. This is what the law is saying. You cannot treat this whole 2,000. The rule says that the amount that you can treat in expenses shall not exceed 5% of the written down value of the pool. So now the pool is 8,000. So you check 8,000 times 5%, you are getting 400. So the law is saying that the expense that you can charge, the amount that you can charge as an expense in a P&L shall not exceed this 400. So you have to treat this one as 400, and you take the difference to the pool as a capital expense. That's basically what this one is talking about. So when you treat the 400 as an expense, the difference, which is 1,600, shall be added to the pool as additions. So when I'm treating capital allowance, I'll add more things and I'll say more things in regards to that, and I'll solve more questions. So in this video, I'm just doing the theoretical aspect. So when we get to the calculations, I'll solve a full questions under research and maintenance. Then I'll solve a full question with you under business income. Now the third principle is talking about, or the third rule of talking about research and development expenses. Now research and development expenses, meeting the requirement of section 9, may be deducted irrespective whether they are of capital nature or not. So you're talking about anything about research and development, you are allowed to deduct it. So in this section, research and development expenses means expenses incurred by the person in a process of developing the person's business and improving business products and processes. But it excludes expenses incurred that are otherwise included in the cost of an asset used in the project referred to paragraph A. So what they are saying that any expense that you're going to incur, which is in relation to research and development, you can treat it as an expenses, or you can treat it as an asset that you add to the cost. So you have the options. Now, if you choose to treat them as an expenses, you cannot add it to the asset. So here, the law allows you to treat the whole amount or the full amount as an expenses if you want, or you can choose to add it to the cost of the asset. Now, capital allowance, in accounting concept, we call it depreciation, okay? But for tax concept, we don't call it depreciation. We call it capital allowance. So what the tax says is that, what the law says is that when you have depreciation, you add it back because depreciation doesn't fit the principle of amortization. So we add it back, then you go and less capital allowances. So I'll treat capital allowances in the next video. But basically, that's the concept of capital allowances. So capital allowance is the same as depreciation. So when I'm doing capital allowance, I'll add and I'll explain further. Now let's come to loss on realization of assets and liabilities. Now, for the purpose of calculating a person's income from a business or investment for a year of assessment, you shall deduct a loss of the person from the realization during the year of assets and liabilities referred to in subsection 2. The loss is calculated under Part IV. The assets and liabilities are A. Capital assets of a business to the extent to which the assets were used in the production of income from the business. B. Liabilities of a business to the extent to which, in the case of liability, that is a debt obligation incurred in borrowing money, the money was used, or an asset purchased with the money was used in the production of income from the business. And in the case of any other liability, the liability was wholly, exclusively, and necessarily incurred in the production of income from the business. And C, chargeable assets of an investment to the extent to which the assets were used wholly, exclusively, and necessarily in the production of income from investment. Now let's come to limit on the deduction of financial cost. Now, what is financial cost? Financial cost is basically foreign exchange losses. I mean, you buy something from outside Ghana, you bring it to Ghana, you want to sell it back or you want to resell it, but because of the exchange rate, okay, you wouldn't get the same amount. Or it can be that you go and borrow money from outside Ghana, like Dubai, you bring the money to Ghana, you have to repay the money back. The rate at which you borrow the money might be different from the rate at which you're going to pay the money. So we call it like financial cost. It's just a matter of the exchange rate and yes, exchange rate. So you are saying that the amount of financial cost other than interest deducted in calculating a person's income from conducting a business or investment for a year of assessment shall not exceed the limit referred in subsection 2. Now, the limit is the sum of the financial gain derived by the person that are to be included in calculating the person's income from the business or investment for the year of assessment plus 50% of the person's income for the year from the business or investment calculated without including the financial gain derived or deducting the financial cost incurred by a person. Now, financial cost for which a deduction is denied as a result of subsection 1 may be carried forward and treated as incurred during any of the following 5 years of assessment, but only to the extent of any unused limitation in subsection 2 for the year. Now, carry forwards are used in other in which they are incurred. So regulation may prescribe circumstances in which losses on financial instruments may be set against gains on financial instrument. Yes, so as I said, we have the one, it can refer to the exchange rate and any financial loss as a result of financial instrument. It's also part of the examples. So here is what they are saying. They are saying that yes, you are allowed to deduct the loss, but you can't deduct the full amount if it's higher than the financial gain plus 50% of the chargeable income for the year. And for you to get a chargeable income, the law says that you have to adjust it by adding back the financial loss that you have deducted and lessen the financial gain that you've added. So let's give an example. We have financial gain. We have let's say profit for the year. Profit to be 10,000. We have financial gain, which is FG, to be 1,000. You add it, you have 11,000. You have financial loss, which let's say FL, which is 5,000. Realize I come and get 6,000, right? So yeah, so the law is saying that you have to add. See, in an exam, so you are going to see this amount as 6,000. So let's say the net profit or the chargeable income. So you have to adjust it. And how do you adjust it? We adjust by adding back the loss that you have deducted and lessen the gain that you've added. So it's going to be something like this. So it's going to be 6,000 plus 5,000 minus 1,000. What are you getting? You get the same thing, right? As 10,000. All right, now after adjusting this 10,000, the law says that this is it says it's going to be 50%. So it's going to be financial gain, which is 1,000 plus 50% of the chargeable income. That's going to be the limit. So it's going to be here, going to be 1,000 plus. So take your calculator, 50% times 10,000. So you're going to get 5,000. So 5,000 plus 1,000 give us 6,000. So the law is saying that yes, you can deduct amount limited to 6,000. Then you carry the difference forward to 5 years. So here the limit is 6,000, and our financial loss in this example is 5,000. So you're allowed to deduct all. I will solve my equations in the next video. As I said earlier, this video just explains the theoretical aspect of the rules. Now we come to loss from business or investment. For the purpose of calculating the income of a person from a business for the year of assessment, deduct an unrealized loss of the person of the year from the business. Now, in the case of a specified priority sectors, so this one used to, but now yes, at first there were some, but now all the business are allowed to carry their losses to 5 years. So this one no longer applies. So currently 2023, all businesses are allowed to carry over losses for 5 years. So if you, let's say in year 1 you make a loss, in year 2 you make a gain, you are allowed to go and deduct the loss that you made from year 1 from year 2. Now, what contribution and donation to worldwide cause? Now in Ghana, it's not all the donations that you are going to make that you are going to be allowed to deduct it or to treat it as an expenses. Some of them you are not going to be allowed to treat them as expenses. So the law gives us some of the items that we can treat them as expenses. So you see that in arriving at the charitable income of a person for the year of assessment under Section 2, the person may claim a deduction equal to the contribution and donations made during the year for the cost referred in Section 2 that have been approved by the government. So all these things that they are saying here, you can deduct, yes, if they are approved by the government. So we have these courses are charitable institutions meeting the requirements of Section 97, scheme of scholarship for an academic, technical, professional, and other course of study, development of any rural or urban areas, sports development and sports promotion, and any other worldwide cost approved by the Commissioner General. So the fact that you have done a donation doesn't mean that you are going to be allowed to deduct it. No, you must go through the process for it to be approved by the Commissioner General. Now, we have domestic expenditure. Now, what is domestic expenditure? Where an individual incurs expenditure in respect of herself or himself. The expenditure is domestic expenditure to the extent that it is incurred A, in maintaining the individual, including in providing shelter as well as meals, refreshment, entertainment, and other leisure activities. B, in the individual commuting from home. C, in acquiring clothing for the individual other than clothing that is not suitable for wearing outside of work. So here they're saying that we don't add domestic expenditure and business income. And what is the domestic expenditure? That's what they have explained here. That it maintains the individual, including shelter, meal, refreshment that are given to the individual in the house. It's not expenses. That's the individual commuting from home. It's not expenses. And any clothes that you're going to give them to the individual, okay, unless that clothes cannot be wear outside. So if you go and buy suit to your staff, the suit, you can't say that it's a business expenses because they can wear the suit in the church. Now, in deducting the individual, other than education, that is directly relevant to the business conducted by the individual, and that does not lead to degree or diploma. So yes, so if you are thinking of your employee like education expenses, you are taking your staff to do on a job training or something. Okay. But if the training will lead them to a degree or diploma, you don't add it. But if maybe you are going to, let's say you are a student or you're an accountant, then you take, let's say, EY to go and do some short course program teaching on how to do the job. It's allowable. But if you are taking to go and do IC or CIT, it's not allowable. 2, where another person incurs expenditure in making payment to or providing any other benefit for an individual, the expenditure is domestic expenditure, except to the extent that the payment or benefit is included in calculating the income of that individual. B, the individual provides consideration for an equal market value for the payment or benefit. And C, the amount of the expenditure is so small as to make it unreasonable or impossible to account for it. Now, expenditure referred in subsection 1 and 2 include interest incurred with respect to money borrowed that is used in a manner referred to those subsections. So saying that if you should go and borrow money to go and use for any of these things, that interest is not going to be allowed to deduct as a deduction. So in summary, the concept of domestic expenditure is talking about an expenses that the business is incurring on the staff or the business is incurring on the individuals. Okay, they are just incurring on the individual, like their refreshment, their lunch, you are buying for them in the house, their water bills, and if they are coming to the office, I mean the bag they will take to the office and all those kind of things. We see them to be a domestic expenditure, but not a business expenditure. Now, what is bad debt? Bad debt, yes, for bad debt to be deductible, different conditions must exist. So that you cannot just stand up and say, oh, this is my bad debt. So I'm going to, no. There are conditions that must be met before you can deduct your bad debt. So first one is it shall be specific, not general. You know, in accounting, we have something called provisions for bad debt, where before you start the year, or maybe at the end of the year, you can conclude that okay, people are owing me 100,000. So let's assume that 10% of these people cannot pay me. It's a general bad debt. But the specific one is when you know that Kwame cannot pay me, or cannot pay me. Those ones are allowable. but for the general one, it's not allowable. It should have formed part of the previous year's income. So let's say if you are doing the calculation for bad debt, the person you should have added to the previous year's income. So let's say if you sold goods to Kwame 10,000, and in year one you added it as sales, and in year two you realize that they cannot pay, you can come and deduct this 10,000 because you have already added it in the previous year's income. 3, it should arise out of ordinary course of business. So yes, the normal business that you are doing, that's where the bad debt should come from, and the necessary steps should have been taken to recover the debt. So if Kwame is owing you, you should have gone through all the means that any other normal person will go through to get it. If you have gone through all the ways, taking the person to court, making it legal that they can't pay you, then you can treat it. But you can't just stay in the house and say, oh, Kwame is owing me and Kwame cannot pay, so because of that, my bad debt. No. Now, excluded expenditure. So the first one was domestic expenditure. Okay, now let's come to excluded expenditure. Expenditure that we don't add it. Now, for the purpose of this act, excluded expenditure means tax payable under this act. That if you are the tax that you are to pay, no tax and expenses. You have bribes and expenditure incurred in corrupt practices, like a police. You are doing something wrong, and the police come and arrest you. You can't go and deduct that money. Interest, penalty, fines paid or payable to a government or political subdivision of a government of any country for breach of any law. Yes, as I said earlier, you go and do something wrong, the police come to arrest you. No, you can't pay deduct that much as penalties. So if you should bribe the police when they come to arrest you, you can't take that money out. In the same way, if they should take you to court and the money that they will charge you, you can't deduct it. Expenditure to the extent incurred by a person in deriving exempt amount of final withholding payment, retirement contributions, dividends of a company, and depreciation of its assets. As I said earlier, these are not allowed. So basically, this is the overview and the theoretical aspect of business income. In the next video, I'll solve questions on the business income and all the sessions and the principles and the rules that follows. So if I say anything that you don't understand, you can leave it in the comment section. Then I'll address it in the next video. And you think that if I say anything that you have more ideas, maybe I said it wrongly, I said something that you think is wrong, that you want to share ideas, you can leave it in the comment. I'll address them I'll address them in the next video. So catch it. See you.